Welcome back, Wealth Builders. If you have been with us since episodes 1 through 4, thank you for staying committed to your financial journey. So far, we have covered mindset, budgeting, income stream, and protections. And now we shift into growth mode, investing.
Let's briefly revisit Maria's story. She started small, contributing 15% of her $70,000 salary to her 401k and Roth IRA. Over time, through consistency and smart investing, those accounts grew to over $600,000 by age 50.
That's the strategy she used. And today, we will show how you can apply the same principle in your own financial journey. Jerry, most people think saving money in a bank is enough. Why is investing better for long-term growth?
Great question. Saving helps you preserve money, but investing helps you grow it. With inflation averaging 2 to 3% per year, your savings lose purchasing power over time. But long-term investments, especially in diversified index funds or mutual funds, historically return about 7% annually after inflation.
So basically, if you are only saving, you are falling behind?
Exactly. Investing allows your money to compound, meaning you earn returns on your returns. That's how Maria turned steady contributions into serious growth.
Let's dive in. Jerry, what are the key building blocks of an investment portfolio beyond just stocks?
A good question. Stocks represent ownership in a company. When you buy a stock, you own a piece of that business. Stocks can offer high returns but come with higher risk. That's why we also consider bonds, which are essentially loans to government or corporations. Bonds provide income and stability, balancing out the volatility of stocks.
Got it. And what about funds? I heard a lot about mutual funds and index funds. How do those fill in?
Both are powerful tools for diversification. Mutual funds are collections of stocks, bonds, or other assets that are actively managed by a professional. Index funds are simpler. They track a specific market index, like S&P 500. They are passively managed, having no fees and often outperforming the index.
That makes sense. What else should builders know about diversification then?
Diversification means spreading your investments across different types of assets, stocks, bonds, and funds, to reduce risk. But it doesn't stop there. Some investors also allocate a small portion to gold for inflation protection or to cryptocurrency for potential high-risk, high-reward growth. The key is balance. Each asset plays a different role in your portfolio.
So it's like having a team of investment, each doing their part then.
Exactly. By diversifying across different asset classes, you protect yourself from the ups and downs of any market. That's how you build long-term sustainable wealth.
Jerry, once someone is ready to invest, what's the first step to build a retirement plan?
The foundation is understanding qualified retirement plans, such as those accounts designed to help you save for retirement while getting benefits. The most common is a 401k offered by many employers. You can contribute up to $23,500 in 2025, plus extra if you are over 50. Many employers match a percentage, so it's free money for you.
What if someone doesn't have a 401k then?
No worries. That's where IRAs, individual retirement accounts, come in. Anyone with earned income can open an IRA, either a traditional or a Roth IRA. A traditional IRA allows for tax-deductible contributions, but you will pay taxes when you withdraw. A Roth IRA, on the other hand, offers no upfront deduction, but qualified withdrawals in retirement are tax-free. In 2025, you can contribute up to $7,000 per year to either type.
So what about self-employed folks or small business owner like myself?
Great questions. If you are self-employed, a SEP IRA is a great option for you. It lets you contribute up to 25% of your net income. This is a big opportunity for freelancers, consultants, and small business owners to save aggressively.
Are there any other plans besides these plans?
Absolutely. There are simple IRAs for small businesses, solo 401k, for self-employed, and even 401b and 457b plans for public sector workers. Each has its own rules, but the goal is the same: grow your money for retirement in a tax-advantaged way.
So the takeaway is whether you are employee or entrepreneur, there's a plan that fits in your situations.
Exactly. The key is to start early, contribute consistently, and choose the plan that aligns with your goals. And don't forget, all these plans can work together. For example, you might max out a 401k and also contribute to a Roth IRA. That's how Maria did it, by using every tool available to build long-term wealth.
Jerry, when someone opens an IRA or 401k, how do they actually manage it for long-term growth then?
That's a great question. Kevin, the key is having a simple, disciplined approach. First, it's crucial to understand your risk tolerance, how much market fluctuation you are comfortable with. That will guide your asset allocation, how you split your investments between stocks, bonds, and other assets. For younger investors, a higher percentage in stocks, like 80%, makes sense for long-term growth. As you near your retirement, you then gradually shift toward more bonds and income-generating assets to protect your capital.
How often should people check their accounts then?
Good question. Many people think they need to watch the markets daily, but that's not necessary. A quarterly review is a good rule of thumb, enough to stay on track without getting caught up in short-term noise. It's also smart to rebalance annually, adjusting your portfolio back to your target mix if one area has grown faster than others. For example, if your stocks have surged, you might sell some and reinvest in bonds to keep your plan aligned.
So what about investment choices with 401k or IRA? How do you know what to pick?
Look for low-cost index funds or target date funds that match your retirement timeline. Many 401ks for a variety of funds, like US stock funds, international funds, and bond funds. Choosing a diversified mix is key. And for most people, keeping it simple is best. Remember, it's not about picking the hot stock, it's about steady growth over decades.
Are there common mistakes people make?
Absolutely. The biggest mistake is reacting emotionally, like selling during a market dip or chasing trends. Another is neglecting your plan, not reviewing it, missing employer matches, or not contributing enough. A good rule of thumb: aim to contribute at least 15% of your income between your IRA, 401k, and any other accounts. And if your employer offers a match, make sure you take full advantage.
So it's about stating the course, rebalancing, and not letting emotion drive decisions.
That's correct. Investing is a long-term game. Stick to your strategy, contribute regularly, and trust the power of compound growth. That's how Maria built her wealth and how you can do.
So far, we have covered a lot today, from investment auction to the best practice of managing your accounts. Maria's story shows us how consistency, strategy, planning, and adjusting over time can lead to real financial progress.
And remember, you don't need to figure it out alone. Whether it's building a robust investment portfolio or enhancing the long-term performance, a financial advisor can be a powerful partner in your journey.
Next episode, we shift gear into real estate, how everyday investors like Maria and others identify their first investment property, secure financing, and begin building additional stream of incomes.
Like, subscribe, and drop us a question in the comments. We'd love to hear what topics you want us to explore.
Your wealth journey is building momentum. Let's keep it going together.